we are able to learn and to shape how the industry is actually evolving, and ultimately have a seat at the table in defining, the next level of customer experiences around discovery and search and all those types of things, and how transactions actually materialize between, the different front ends.
Hello, I'm Russell Poynton from Edison Group, and today it's great to have with me again the management team of Global Fashion Group. Christoph Barchevich is the CEO and Helen Hickman is the CFO. Global Fashion Group released their H1 results today, which were very good at the profit level, and we'll talk more about that. Welcome again.
Thank you, nice to be here.
So Helen, let's start with you in terms of the H1 performance. Good growth in profit despite the decline in NMV. The first H1 profit for the current footprint.
Yep.
Could you just talk about the drivers behind that and what you think that says about the resilience of the business?
Yes, definitely, Russell. So, as you say, a milestone today that it's our first profitable half one at a group level, and importantly, each of our regions are also profitable in the first half. So having made significant adjusted EBITDA margin gains year on year, which obviously we're very pleased about. So drivers of that, as we've spoken with you before, our sort of focus around increasing our marketplace share, our platform services business, so whether that's be around our single stock solution in Southeast Asia, focusing on retail media across all of our regions, and also our marketplace and the growth that we're starting to see in our fulfilled by operations, especially in Australia and to Latin America to some extent. We've also had a continued focus around cost control and delivered significant both sort of cost but also efficiency savings across the group. And as you say, we've delivered a 9 million adjusted EBITDA improvement in that first half against a backdrop of slightly lower year-on-year NMV. So I'm pleased with the sort of the profit resiliency of the group despite some of the headwinds we've seen on the top line.
And when you're talking about the company, you're emphasizing this shift from volume to value. So can you just talk about how you think investors should think about that?
Yeah, very much so. So we're very much taking a broad view around order and customer economics. I'm seeing significant improvements in profitability at all levels per customer and per order. So we take some sort of data points. Over the last 3 years, our active customers and our orders have broadly reduced by about a quarter. But within that time frame, we've seen our profitability per transaction, so per order or per customer, increase significantly. So at a point of sort of profit, so gross profit after marketing and after fulfillment, we've seen those metrics increase by sort of close to 90% at a group level, but also improvements across all of our regions. So it very much is how we're working to ensure that we retain the higher value, the better quality customers and attract and retain those to build loyalty with that customer base. And I think it's not just purely cost efficiency that's driving that. If we look at things like our order frequency, so our customer order frequency is starting to increase along with their average order value as well. So some good indicators around that more resilient and more profitable customer base.
Good, thanks for that. We'll come back to you later when we talk about the outlook, but let's shift across to Christoph to talk about the regional performance. Christoph, ANZ continues to be the engine of the business with NMV growth of about 3% through the first half. And that's despite more challenges on the Australian consumer, as we know. Could you just talk about that resilience and how sustainable you think that growth is going forward for the ANZ business?
Yeah, certainly. I mean, we're definitely pleased with the performance in the context, right? I think we have medium-term growth ambitions that are certainly beyond where we are in the first half. But I think in the environment that we've been facing, especially in the last couple of months, I think this is a very solid result, growing and also improving profitability. I think the key drivers for that is, number one, the assortment. We have an excellent assortment across categories, across price points, and marketplace and retail, the two business models are really kind of playing together there, making sure that we're as relevant as possible for the customer. We're disciplined on the inventory side, so that remains healthy. And yes, in some areas, we need to be a bit more aggressive on pricing to meet the competitors where they are or to really entice customers. But generally, we've been able to maintain gross margin, and we've then improved the bottom line through very disciplined cost side, in particular marketing, where, similar to what Helen just said around the customer economics, we're really targeting the highest value customers, the most relevant transactions, and also pulling back spending in areas where we think we could actually get the transaction irrespective of the marketing spend. And so making sure we don't spend marketing where we don't have to.
And with the Google UCP pilot announcement, which is a bit of a mouthful, it looks as though ANZ is going to be a key testbed for AI-enabled commerce going forward.
Yeah.
Could you just talk about what AI means strategically for GFG Group?
Yeah, it plays a huge role across the entire business. And I think on the UCP specifically, this is the very beginning of agentic commerce, as the industry is calling it. To be clear, we don't expect this to be a big commercial driver, but I think what is critical is to be the first fashion retailer in Australia to be part of that very important pilot with Google. We are able to learn and to shape how the industry is actually evolving, and ultimately have a seat at the table in defining, the next level of customer experiences around discovery and search and all those types of things, and how transactions actually materialize between, the different front ends, and obviously our app playing a critical role in that. If you think more broadly about AI, we really think that is a driver of both efficiency and growth. Short term, we think it's probably more balanced towards efficiency. So examples we've talked about, as well as certainly the obvious things like customer service automation, where, we're shifting towards the majority of our customer service requests and inbounds being dealt with by AI-enabled systems, and interestingly, at the highest ever customer satisfaction. So often people think automation is a trade-off, and the human will deliver better customer satisfaction. That's actually shifting now. Same on content production, on pricing. There's just so many areas, and we really see artificial intelligence kind of start to be embedded in pretty much everything we do in the business. And in every single area, there's some use case, and obviously we then need to prioritize on the deployments and test and learn and progress as this technology evolves and our business evolves.
Great. Let's shift over to LATAM. It's a profitable first half. Top line trends are a little weak there, and you've talked about competitive pressures that have affected the top line growth. But the profitability has come through. So could you just talk about how you've protected that profitability in the region?
Yeah, in a fairly tough environment, and the World Cup in particular is huge in Brazil, also in Colombia actually. So things kind of go a little bit into pause while all the football's on. But beyond that, I think it's been a bit of a tougher trading environment in the first half. I think we're very pleased to see that on a gross margin perspective, we've been flat year on year. So, very healthy level of gross margin. And then where we've really been able to improve the 3 points on the adjusted EBITDA, that's coming basically from the fulfillment and the efficiency around that, and also growing the fulfilled by business and thereby increasing the usage of our infrastructure. It is on the marketing side being very, very targeted and selective, again, going back to this customer profitability and kind of very targeted approach. And then we continue to take out costs also at the overhead level wherever we can. And, obviously a lot of that has happened in the last couple of years already, and there's not as much happening there anymore, but there's still some opportunities that we have delivered in the first half.
Great. And finally, Southeast Asia, a good job of improving profitability, as Helen said already. Still quite weak trends at the top line. And there's a lot of operating cost changes over the last 12 months. What have you done in the last 6 months to help protect the business going forward?
Yeah. I mean, we've done a lot of work on the cost structure, and that's obviously driven the profitability. But I think to the point of the top line trends, which we're definitely not happy with. Nobody wants to be in a business with a double-digit top line decline. But having said that, we think there's a couple of green shoots and underlying initiatives that are really working towards turning that around. And I think the ones I would call out is clearly both of the areas of the commercial side and the marketing side. So on the commercial side, our top 30 brands are actually doing better than the overall assortment. And so they're performing more strongly, they're gaining share within it. Part of that is us deprioritizing the very long tail, and part of that is really prioritizing the big brands and working more closely with them. That then goes into topics like unlocking better segmentation, so more exclusivity for our platform, more relevance, and really kind of that weekly, monthly cadence with the brands to make sure that we have the most relevant offer for the consumer on the platform at the right price. 50% of the business is marketplace, so some of this is what we buy, but some of it is also, how we work with our partners to bring the relevant product through the marketplace channel. So that's been a big priority, and I think we've made some good progress there. On the marketing side, we have done a few things. We've invested a lot more into all the CRM and, let's say, the organic channels, and a lot of that is happening on the app. We're 90% app business in the region. So I think if you would compare what you see on the app now versus what you saw a year ago, it's a lot more exciting, relevant, fashion forward than what we used to do. And then also on the performance marketing side, we are again applying this very selective lens. And I think the discipline we're trying to hold is, we want to be a order profitable and customer profitable business. And so within those constraints, the top line is kind of an output versus an input, but we see the inputs moving in the right direction.
And just a quick follow up on that. Are the trends in the region fairly uniform across the countries? There's no one country which is.
There's volatility month on month between the countries, and there's external factors that play out within them. But I would generally say the 4 core markets, Philippines, Indonesia, Malaysia, and Singapore, it's pretty similar. Hong Kong is a market where we have put less priority. It's the smallest of the 5 markets we're in. So we're willing to give up a little bit more volume even there because we see it as less core to the overall footprint.
Great, thank you. Finally, Helen, on the outlook. So good profit performance in the first half, and you actually narrowed up your guidance on profitability for the year despite taking down your guidance for NMV for the year. What gives you confidence in that profit delivery for the year?
So I think, so maybe just to recap, so as you say, on our top line guidance, we've narrowed it and we've taken down the top now, so it's between 0 and -4%. But our profit, we've kept the top end of guidance at 25, but moved from a bottom of 15 to 18. So the drivers of that really are focused around the H1 delivery that we've got to date. So we're, as we've sort of spoken about, very pleased about that delivery. And really where we then get to between the 18 and the 25 is pretty dependent on the top line. But what we're clear on and what we've demonstrated to date is despite that volatility in the top line, we have enough, whether it's business model initiatives or cost of and effectiveness initiatives, to then drive through and be resilient against that top line to be confident around that profit guidance.
And does that affect your guidance for normalised free cash flow break even?
So no, so we don't guide on normalised free cash flow, but we're very clear that becoming break even is our number one sort of milestone. So maybe if I take a couple of numbers to help share on that. So last year we used 32 million of cash from normalised free cash flow. If I now take the last 12 months and move it on 6 months, that's now at -19. So year on year, we've stepped forward 28 million on our cash position. So I feel comfortable that delivery in H1 very much goes towards us becoming normalised free cash flow break even.
Great. Sorry for using the word guidance there instead of expectations.
Don't worry, it's a key metric. So we're all focused on it.
Great. Well, Helen, Christoph, thanks very much. Great delivery on profits in the first half, and we'll look forward to seeing the progress in the second half.
Thanks, Russell.